On the same street in Amsterdam where Marcus was selling his diamond inventory in May 1940, a man named Willem was buying. Not diamonds, something adjacent to them in the logic of crisis. Willem ran a small import business. He had connections in Switzerland, a modest foreign currency account that predated the war, and the particular cold-headedness that certain people discover they possess only when everyone around them is losing it. When the occupation descended and the first wave of distressed asset sales began, Willem was not selling. He was asking what was available and at what price. He bought a warehouse lease at roughly a quarter of its pre-war valuation. He acquired the inventory of a textile merchant who needed immediate cash to arrange transit documents for his family. He took on a printing business at a price that reflected the seller's urgency rather than the business's capacity to generate income once the disruption passed. He was not heroic. He was not prescient. He simply had something available, a modest sum in a currency that was not being devalued overnight. At the moment when everyone around him needed to convert assets into that currency, regardless of the price they received. By 1946, the warehouse lease had been renegotiated at market rates. The textile inventory had been sold through channels that reopened after liberation. The printing business was producing income. The acquisition prices Willem had paid in May 1940 were, measured against the recovery values of the following years, among the most extraordinary transactions of his commercial life. He had not predicted the occupation. He had not assembled his Swiss account in preparation for war. He had simply, by habit and temperament, kept something outside the system that the crisis was repricing. And when the crisis arrived, that something put him on the buying side of transactions where everyone else was selling. This is the other side of the story. Every crisis produces sellers who receive terrible exit prices. The previous script documented what they lost and why. But for every exit price, there is an acquisition price, the same transaction, the opposite seat at the table. And the question of who sits where, who exits and who acquires, is determined almost entirely by decisions made before the crisis, not during it. Most people, thinking about crisis and wealth, focus on what not to lose. The historical record suggests an equally important question. What would you be able to acquire, and at what price, if a crisis arrived tomorrow? Because the answer to that question has generated more significant wealth accumulation across more documented historical periods than almost any other financial mechanism. The surface observation is simple. Buy low, sell high. Crisis creates low prices. Therefore, buy during crises. That observation is correct and nearly useless because it tells you nothing about how to be in a position to buy when the people around you are desperate to sell. The deeper question is structural. What creates the asymmetry between the buyer and the seller in a crisis transaction? And can that asymmetry be understood clearly enough to be useful? The answer is yes. Oh, and it runs through 5 documented cases that span a century of crisis acquisition. Go to the United States, the summer of 1932. The Dow Jones Industrial Average is trading at 41 points. 3 years earlier, it had been 381. The decline has been so severe, so sustained, so psychologically grinding that the financial press of the period is not publishing optimistic forecasts. The mood is not fear. Fear implies uncertainty about the future. By 1932, the mood is closer to resignation, a collective conclusion that the economy had fundamentally broken and that recovery, if it came at all, would take a generation. Into that environment, a small number of buyers, not all of them wealthy, not all of them sophisticated, were acquiring equities at acquisition prices that would, within 2 decades, produce returns that seem impossible in retrospect. One documented case is that of John Templeton, then a young man of modest means, who borrowed money in 1939, near the end of the Depression's long tail, to buy $100 worth of every stock on the New York Stock Exchange trading below $1 per share. 100 shares of every single one, including companies that were in bankruptcy, including companies that appeared, by every available measure, to be finished. Of the 104 companies he bought, 100 returned value. 4 went to zero. The acquisition prices he paid, set by a market that had concluded these companies were worthless, did not reflect the underlying productive capacity that most of those companies retained even through the Depression. When that capacity reconnected with a recovering economy, the gap between the acquisition price and the recovery value was extraordinary. Templeton did not know which companies would recover. He bought all of them. He was not making a sophisticated analytical judgment about individual businesses. He was making a structural judgment that the acquisition prices available in a market of maximum collective despair were lower than the long-term productive value of the underlying assets across the board, and that diversified acquisition at those prices would produce significant returns when, not if, some form of normalcy returned. He was right, not because he was a genius, because the acquisition prices of 1939 were set by desperation, and desperation is not a reliable measure of productive value. Here is the reversal that the record requires, including because the story of crisis acquisition is not uniformly admirable. Germany, 1923, the height of the Weimar hyperinflation. Foreign currency, dollars, pounds, Swiss francs, had, in relation to the mark, achieved purchasing power so extraordinary that a modest sum in any stable currency could acquire German assets at prices that bore no relationship to their productive value. Foreign buyers came. Some were opportunists. Some were speculators who had no particular connection to Germany and no interest in its recovery. They bought apartment buildings, commercial properties, manufacturing businesses at acquisition prices denominated in marks that were, in dollar terms, almost nothing. A building that had taken a German family 3 generations to accumulate could be acquired for the equivalent of a few $100s by a buyer with access to foreign currency. The acquisition prices were real. The returns, for those who held through the stabilization and into the recovery of the mid-1920s, were real. The mechanism was the same as every other crisis acquisition case in this script, but the moral character of those transactions was not the same. The sellers were not making rational decisions in a functioning market. They were liquidating family assets to buy food. The buyers were not providing capital to productive enterprises. They were exploiting a monetary catastrophe that had been imposed on an entire population by forces largely outside their control. Yet the historical record of the Weimar period is not silent on this. The resentment generated by foreign acquisition of German assets at hyperinflation prices was documented, real, and politically consequential. It became part of the texture of grievance that shaped German politics through the following decade in ways that had nothing to do with finance. The acquisition price mechanism does not come with moral instructions. It operates regardless of whether the buyer is admirable. The Weimar case is in this script because the record requires it, and because understanding that the mechanism can produce outcomes that are financially rational and morally troubling simultaneously is part of understanding it honestly. Most crisis acquisition does not carry that weight. Most of it is simply people with available liquidity buying assets from people without it. But the Weimar case is a reminder that the asymmetry between buyer and seller in a crisis is not always symmetrical in its human consequences. Move to Japan, 1946 and 1947. The occupation is underway. The zaibatsu are being dissolved. The physical reconstruction of the major cities has barely begun. The yen is inflating. Formal credit is almost entirely unavailable. In that environment, a category of acquisition was taking place that did not look, at the time, like the foundation of significant future wealth. Small plots of urban land in Tokyo, Osaka, and Yokohama, often rubble, often legally complicated by the disruption of the war and occupation, were being acquired by buyers who had two things: some liquidity in a stable form, and a specific conviction. The conviction was not sophisticated. It was simply this: cities rebuild, people return to cities. Urban land in major cities does not stay rubble. The function of urban land, proximity, connection, density, does not disappear because the buildings on it have been destroyed. The acquisition prices available on Tokyo land in 1946 reflected the condition of the city at that moment. They did not reflect the condition of Tokyo in 1960, when the Japanese economic recovery had produced one of the most dramatic urban transformations in modern history. The gap between those two prices, the 1946 acquisition price and the 1960 market value, represented for the buyers who had held through the Reconstruction years wealth accumulation of a kind that no formal financial instrument of the period could have matched. They were not predicting the Japanese economic miracle. They were observing that urban land performs a function, and that functions which exist in rubble continue to exist in reconstruction. If you want to understand how this pattern of function-based acquisition has played out across different types of post-crisis recovery, what the documented timelines look like, and what distinguished the acquisitions that recovered fastest from those that took longest, that is exactly what the next video gets into directly. The fourth case is the one that doesn't appear in any financial history of crisis acquisition, not because it is obscure, but because it is not usually counted as an asset. Argentina. 2002 and 2003. In the months after the peak of the crisis, a wave of emigration had removed a significant portion of Argentina's professional class from the country. Doctors, lawyers, accountants, engineers, architects, people with internationally portable credentials who had chosen to rebuild their careers in Spain, Italy, Mexico, the United States. The professionals who stayed, who had chosen, for whatever combination of reasons, to remain in Buenos Aires and work through the crisis, found themselves within 12 to 18 months in possession of something that the emigrants had left behind. Client relationships, practice positions, market share in professional services that the departing professionals had abandoned. Not through any aggressive strategy, simply through presence. Through continued availability in a market that the crisis had partially emptied of supply, while the demand for legal advice, for medical care, for accounting services, for engineering expertise, continued regardless of what the peso was doing. The acquisition price for those client relationships was not money. It was time, continued practice through difficult conditions, and the willingness to remain operational when the temptation to leave was real and the reasons to leave were legitimate. A lawyer in Buenos Aires who had retained his practice through 2001 and 2002 found, by 2003 and 2004, that the client base available to him had expanded significantly, not because he had sought it, but because the professionals who had previously served those clients were no longer there. The acquisition price of that expanded practice was the hardship of staying. The return on that acquisition was measured in decades of income from a client base that had effectively been repriced by crisis emigration. This case does not fit neatly into a financial framework, but it fits precisely into the acquisition price framework that runs through every case in this script. Something was available at a price set by crisis conditions that did not reflect its long-term value. The people who acquired it did so at the moment of maximum difficulty. The return accrued over the years that followed. The fifth case is the one that ties the pattern together. And it is, in a sense, not a case at all. It is the observation that emerges from looking at all four previous cases simultaneously. The buyers who made the most significant acquisitions in every crisis period documented here were not uniformly wealthy. Templeton borrowed money to buy Depression-era stocks. William in Amsterdam had a modest foreign account, not a fortune. The Tokyo land buyers of 1946 were not, in most cases, pre-war elites. The Argentine lawyers who stayed were middle-class professionals who had made a non-financial decision to remain. What they shared was not wealth. It was a specific structural condition at the moment of crisis. They were not themselves distressed. They were not trying to solve an immediate liquidity problem with the assets they were considering acquiring. They were not competing with their own need for cash against the opportunity in front of them. The acquisition price is only available to someone who does not need to sell something else to take advantage of it. The moment you are also a distressed seller, trying to solve your own crisis while simultaneously recognizing the buying opportunity in front of you, the acquisition price becomes inaccessible. You cannot be on both sides of the transaction simultaneously. Walter, the Iowa farmer from an earlier script in this series, understood the acquisition price available on his neighbor's foreclosed land in 1932. He could see it. He could calculate it. He could not access it because his liquidity was already committed to his own survival. The acquisition price was visible to him. It was not available to him. The difference between those two conditions, seeing the opportunity and being able to act on it, is the entire gap between the buyer's outcome and the seller's outcome in a crisis transaction. Come back to Willem, on the Amsterdam Canal Street in May 1940, asking what was available, at what price. He was not smarter than Marcus, who was selling his diamonds 3 buildings down. He was not more courageous. He was not better connected or more financially sophisticated. He was simply, at that specific moment, in a structural condition that Marcus was not. He had something available that was not already committed to his own survival. And that structural condition, not intelligence, not prediction, not courage, was what put him on the acquisition side of transactions that the crisis was generating by the hour. The 5 things that people sold in a crisis that made others rich were not special assets. They were ordinary assets, equities, property, land, professional positions, business relationships, at acquisition prices that crisis had set far below their long-term productive value. The wealth created on the buying side of those transactions was not a reward for insight. It was a reward for structural preparation, for having arrived at the crisis already positioned to be a buyer rather than a seller. That position is not assembled during the crisis. It is assembled in whatever quiet period precedes it. The crisis does not create the opportunity for everyone who recognizes it. It creates the opportunity only for the people who are not already on the other side of the table. What side of the table would you be on? If the crisis arrived tomorrow? Not because a crisis is coming, but because the answer to that question, if you sit with it honestly, tells you something specific about what the next quiet period is actually for.